Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Pat Brown back on the podcast for our One Big Beautiful Podcast Part 3. Pat is an international tax partner in PwC's Washington National Tax Service practice, where he serves as the National Tax Office co-leader. Pat, welcome back to the podcast.
Once more into the breach, Doug.
Right. So, I grew up as a Star Wars kid, right?
Okay,
in the
sure.
late 70s, early 80s, and we had Star Wars. Then we had Part 2, right, which was the Empire Strikes Back. I feel like I missed an opportunity with Part 2 not calling it the Senate Strikes Back. But we're going to call Part 3, instead of Return of the Jedi, Return of the G7.
Okay.
Right?
Okay.
You like that?
I like it.
All right. So this is the last episode of our three-part trilogy for the One Big Beautiful Bill Act that was signed into law on July 4th, 2025. I was more skeptical than you were.
Yeah.
And the Republicans did get it done.
Yeah.
I note that we're going to cover both OB3 and the G7 announcement on Pillar 2.
Yep.
Let's start with OB3.
Yep.
Pat, what is your C-suite summary of the key business tax provisions of OB3 for those that don't want to suffer through our first two podcasts?
Well, look, I think Congress set out at the start of this reconciliation bill exercise with a very strong desire, I'll call it a commitment, to try and deliver certainty. So if I'm a head of tax and I'm talking to my CFO or CEO, the headline message that I would be delivering is Congress broadly succeeded in doing what they set out to do. So the action forcing event everyone will recall for this bill was we had a bunch of provisions, notably on the individual side, but also on the corporate side, that were going to expire at the end of this year. So we were going to have the FDII rate go up, the GILTI rate go up, the BEAT rate go up, the BEAT calculation get much more onerous. We were also going to have a bunch of changes on the individual side, of course, and that was really the locomotive that drove the tax bill exercise. But we come to the other side of this. Oh, and I didn't even mention, Doug, the so-called TCJA orphans, right? So 163J, which had expired and changed to a more onerous computation at the end of 2022. R&D expensing had become mandatory capitalization and amortization, and of course, bonus depreciation or expensing for plant and equipment also was in the process of phasing out. So what did Congress do in this bill? If I'm talking to management, Congress delivered a international tax system as well as addressing the TCJA orphans, all on a permanent basis. Now, is anything ever permanent in the tax law? You and I know, and I'm sure our listeners know, not really, because Congress is, always tinkering in the law. But we are now freed for the first time in a decade from these phase outs and sunsets and other things that really do make planning for new investment much more challenging for companies. Obviously, the world is filled with all measure of uncertainties, but when you're trying to, as the head of tax, when you're trying to advise your C-suite, what should I assume in terms of the tax rate I will be subjected to if I choose to own this intellectual property in the United States, if I choose to expand my operations inside or outside the United States? Well, at least nominally, you're free from a lot of the asterisks and caveats that you'd have to put in, because virtually everything that the Congress did in this law, they did on a permanent basis. And that was very much by design. And it's also worth noting, Doug, that's hard to do in a reconciliation bill because permanence is expensive. And everything in a reconciliation bill has to be run through the sausage grinder of the revenue score so that you don't effectively blow the budget that was established in the reconciliation bill. So it's a pretty significant achievement to get this done, not just in the timing that it took, that they were able to achieve, getting it to President Trump by July 4th, but actually achieving permanence across so many of these provisions. That's quite a significant accomplishment. Now, you know, for a lot of companies who have come to or had come to start to make investments based on a lot of the green energy incentives in the Inflation Reduction Act, not so great news there, because the Inflation Reduction Act incentives took a big hit. They didn't disappear. Some of them are disappearing, but many others of them are going to get phased out on a more aggressive timeline. So, you know, for companies that were looking to make investments or were making investments based on those Inflation Reduction Act incentives, some of that stuff took a pretty hard hit, mostly not retroactively. So that's really good news for those things. But to the extent you were looking to make new investments in reliance on some of those incentives, you got to look at that a little more closely.
Yeah, and the comment that maybe that I would make, I feel like this is the first time in a long time where we're no longer going to have these, what I would refer to as very important provisions that are characterized as these orphan provisions, right? To your point, we now have certainty on the corporate provisions, also in a number of the individual provisions. Which, as I kind of look into my crystal ball, and it's always foggy, but, and I'll remind some of our non-US listeners, it does now create certainty for a longer period of time. Obviously, a new administration, a Democratic Congress could come in. But, you know, Pat, I view as some of the 3 points that you make, the 100% bonus depreciation, the immediate expensing under 174, the changes to 163J as, you know, generally pro-growth, you know, policies that you would hope that both a Democratic and Republican, whoever would be leading, whatever party would be leading in the future, would potentially stick with that. Maybe just a couple of points on those that you raised on the immediate expensing. There is an election to capitalize, so if taxpayers want to do that, they can. There's also those orphan deductions, to continue to use that term, from 2021 through 2024, I believe, that large taxpayers will have the opportunity to effectively use those and carry those forward. An important note on 163J, because this really can change the math, particularly for US MNCs that have foreign subs underneath the US, that 163J is now calculated, first of all, before interest capitalization provisions, so that's a meaningful difference. But it also now excludes subpart F, GILTI, 956, the section 78 gross up. So I would encourage listeners that are close to that 163J before these changes, there could be some impact. Obviously, you get the benefit of the depreciation and amortization, but now GILTI gets kind of sucked back out of there.
Yeah, and I would just add to that, Doug. I mean, tax departments and tax directors are relatively used to this exercise of managing tax base, trying to deal with the interactive or interlocking nature of these provisions. But the reality is, you know, the deck's been reshuffled as a result of this bill. So even if you're used to doing that, you're going to have to resharpen your pencils and do some of this analysis afresh. So one of the things, for example, that's come up a lot, you mentioned, you know, the option to accelerate your not yet fully amortized Section 174 expenses that you capitalize and amortize during the period of required amortization. You have a catch-up option to accelerate that and take it all in the current year or take it all over a couple of years. Well, for a number of taxpayers, I'm sure you're having similar conversations. They've said, hey, this looks great, but if I take this all this year, I'm going to be in the BEAT. Or I'm going to be subject to the QMT. And so analyzing the interlocking nature of these provisions is going to be incredibly important for folks. And, you know, there are always rakes in the yard, unexpected interactions. So, you know, as much as one may be tempted to look at this and say, hey, this is all great news, to be sure, it is great news. But if you're unguarded in the way you approach it, you may end up tripping over some things that you might really regret. One example, again, I just mentioned it, the BEAT is a permanent tax. There is no recapture of that. There's no AMT credit associated with the BEAT, even though it's a minimum tax type concept. So if you accelerate your R&D amortization and it causes you to be in the BEAT, you've just made a bad decision, right? You've cost yourself money. You've essentially traded off a timing item for a permanent tax item, and that's generally speaking, almost never going to be a good trade.
Right.
So.
Yeah, and so the native enactment was July 4th. So from an
Right.
accounting perspective, for those public companies, you need to do the math and figure out how that impacts potentially deferreds.
Right.
And then to your point, where you've got elections, when there's an opportunity or an elect to be able to capitalize and or over a
Right.
time frame, whatever, obviously it means you got to do the math so
Yeah.
that you know which is going to be the most advantageous. And
Right.
so generally that math needs to be done for purposes of determining what those deferreds might be. So
Right, right.
plenty of homework for,
Yes.
for taxpayers
Yes.
with this. And the point just to emphasize is that there are collateral implications with taxable income. The BEAT is a great example,
Yeah.
and sort of the collateral implications
Right.
of some of these elections
Yeah.
are important for taxpayers to keep in mind.
Right, right.
Let's talk briefly about some of the international provisions. I am
Yeah.
going to do another podcast with a deep dive on the international provisions. But what are some of the notable provisions, really focusing on FDII,
Yeah.
GILTI, and BEAT?
Yeah, so all three of these got a close look by the Senate. And just to remind everybody, right, we had the House version of the bill, we had the Senate version of the bill, and then, of course, once the Senate passed their version of the bill, the question was, will the House basically be able to get on side, everybody on side, all the Republicans essentially on side, and pass the Senate version of the bill, or will it essentially be a different version that has to pass the House and goes back to the Senate? In the end, of course, the House accepted the Senate's changes, and so the Senate version of the bill became the final bill. There's still a lot of the House bill in there, but recall, what did the House do with the international provisions that you mentioned, GILTI, BEAT, and FDII? They slightly tweaked the rate, but they otherwise kept those provisions at current law on a permanent basis, and that's it. And it was very much a design decision by folks on the House side to say, we're extending what was done in TCJA, and we're going to get out of Dodge. We're done. The Senate was more ambitious, and they came at this and said, you know, we want to see if we have an opportunity to make some improvements to the international provisions, of course, on a revenue neutral basis, broadly speaking, revenue neutral basis. And what we saw was an attempt by the Senate to look at all three and make some changes. With respect to FDII and GILTI, we did see changes that I'll talk briefly about. With respect to BEAT, in the end, we didn't see changes, although we did see an original version of the Senate text that would have made some quite meaningful changes to the BEAT that were kicking up a lot of dust. And some folks were quite happy, some folks were quite unhappy about those changes. But in the end, really, the Senate ended up retreating to really just tweaking the rate on the BEAT from 10 to 10.5.
Probably dedicated too much time on part one and part two on that if we knew where this was going to
Yeah,
land. But,
yeah.
it was an interesting thought experiment.
Although, you know, one thing that I hate to say this, but you know, bad ideas in Washington never really die. They just end up in some staffer's file drawer, and then the next time there's a need for revenue, they get pulled out again. So, you know, things may
keep those in mind.
Yeah, things may resurface. So, but let me focus first on GILTI and then on FDII very quickly. So, what did they do in GILTI? The big benefit here to taxpayers, far and away the big benefit, was addressing expense apportionment. And this was, again, you know, way back in 2017, if you read the legislative history, the committee report coming out of the TCJA, it sounded like GILTI was a minimum tax. So if you paid more than 13.125% foreign tax on your GILTI, on your tested income, you wouldn't owe additional U.S. tax. Now, you know, and I know, and lots of our listeners know, that didn't actually work out that way because the GILTI provisions were not adopted as a standalone minimum tax. They were instead adopted as effectively a foreign tax credit basket subject to a special deduction in Section 250. But putting them in Section 904, the foreign tax credit area, meant that all the foreign tax credit rules, broadly speaking, applied. So the apportionment of expenses became a real, frankly, millstone around the neck of a lot of companies and meant that they were paying residual U.S. tax on GILTI, even though their GILTI was subject to relatively high foreign tax, well north of 13.125. This has been something that Congress has been hearing about basically since 2017.
Oh, yeah.
You know, almost without a break. So the Senate really wanted to try and go after this. And in the end, what did they do? They provided by statute that interest and research expense will not be apportioned against GILTI. So those will instead be going against U.S. source income. That's the best answer you can really have. They don't go against other foreign source income where it could spill back over and affect GILTI. It could still affect your GILTI if you end up with an overall domestic loss. But they take those two big categories of expenses and by statute say you no longer have to worry about those putting you into an excess credit position on GILTI or exacerbating an excess credit position. Big news. Now, in the case of research expense, this was already provided by regulation. But in the case of interest, it wasn't the case. And of course, you know, how stable was that regulatory framework with respect to research expense? So this was a big deal and a very significant benefit for a lot of taxpayers. But revenue neutral means revenue neutral. So you get some good news, you get some pay-fors that offset it. In the case of GILTI, we saw the rate go up, right? Yep. From a nominal rate of 10.5 up to a nominal rate of 12.6. We did see them carve back the 80% FTC limit or the 80% FTC cap, how to describe it, limit or a cap, whatever. So now instead of only being able to credit 80% of your tax on GILTI, you can credit 90%. That's a benefit. Yeah. But what we also saw get taken away is this concept we have in the GILTI regime or had in the GILTI regime of QBAI, Qualified Business Asset Investment. It's very closely analogous to the Pillar 2 substance-based income exclusion. And that got pulled away as well. So essentially what that means is that now GILTI applies effectively to your first dollar of foreign earnings. You're no longer entitled to an exemption based on what percentage or what the basis is in your property outside the United States. So GILTI is essentially now a concept that applies to your first dollar of tested income. You take all those changes together, for a lot of taxpayers, for a lot of the companies that you and I talk to on a regular basis, what stands up is a significant benefit from the expense apportionment relief.
Right.
So, you know, obviously everybody's facts are going to differ, but this is one that folks are going to want to look at quite closely and see how much does this change the GILTI computation. It does get us much closer to a true minimum tax concept. We're still not there as a true minimum tax concept because GILTI still sits in Section 904 as a foreign tax credit basket. So there are aspects that we'll still have to kind of, that taxpayers will still have to run through and be careful about. But GILTI looks a lot more like a minimum tax on the other side of this bill than it did before.
Yeah, maybe one comment before we move on to FDII on the GILTI. For those taxpayers that are excess credit, you know, generally speaking, you would think they would be in a better position.
Yes.
Even though the rate has gone up to 14, they can now use 90% of the credits. They no longer have to do expense apportionment, at least for interest and R&E.
Right.
I think stewardship, presumably, if that's directly allocable expense, I know that's still up in the air. I think many of us would have hoped to have some clarity on that, but it feels like stewardship may still be in there.
Yeah.
But generally speaking, if you're above that rate and you're blended, you're going to be in a better position from an FTC position.
Right.
For those taxpayers that have a blended rate below what was the 10.5, generally what this means is they've got an incremental almost 2 points.
You're going to pay more tax.
They're going to pay. You're
going to pay more tax on your GILTI because the rate went up. And you no longer have the benefit of QBAI, which protected some of what for these taxpayers was low-taxed foreign income from tax under the GILTI regime. You mentioned, Doug, the directly allocable. That is the language that Congress included in the GILTI changes to say essentially the only expenses that will be taken against GILTI are those that are directly allocable against your tested income. I'm not sure any of us really know exactly what that means.
No.
And you know, if you spend a little time, as I have recently, in the code sections and the regulations, 861 and what follows and the regulations they're under, there is basically just a kind of alphabet soup of terminology that's used to describe these concepts. So if you're like, oh, directly allocable, I know exactly what that means. I challenge you. You might think you know what it means, but go read the regulations and come back and tell me you're still confident that you know what that means, because the terms are used in this very kind of inconsistent manner. So ultimately, this is going to be up to Treasury to sort out that regulation. And we certainly will get guidance. The question is, how generously minded is Treasury inclined to be? And obviously, we'll just have to wait and see how that plays out. So FDII, interestingly enough, a similar set of changes. So a big deal here on expense apportionment. They tell us specifically in the FDII provisions that no longer will you allocate interest or research expense against essentially FDII, but the precursor to FDII, deduction eligible income. So you'll no longer allocate those large categories of expenses against FDII. Big benefit, significant benefit there for a lot of taxpayers. The rate goes up, so that's a bad guy. But what may be one of the more significant changes here for a lot of taxpayers is you no longer have to take into account QBAI in your FDII computation. So your FDII benefit can start at your first dollar of FDII eligible income. And again, that's going to be a big deal for taxpayers that had a lot of capital or have a lot of capital investment in the United States. So that's a significant change in the good direction here. Now, there's another change in the FDII provisions, which is, hey, to the extent you're looking to outbound, to move intangible property from the United States to outside the United States, essentially selling it or transferring it in a 367D transaction outside the United States, you're not going to get FDII for that. That, in some respects, is an unsurprising result, right? Yeah. FDII is intended to be an incentive to own IP in the United States. So if you're Congress, you can understand them saying, well, why would we give you an incentive for owning IP in the United States when what you've just done is sell it outside the United States? So, but on balance, I'd say some, good news there on the FDII front as well. Again, the rate goes up, and so that's, but it's a modest increase, frankly, from 13.125 up to 14. But then you get to see these other changes as well that are going to be taxpayer.
The really important one related to FDII, Pat, for me is this is now permanent, right? So for whether you're for U.S. parented groups, foreign parented groups, there's always been discussion about, well, do you move even the U.S. IP, whatever IP rights, keep them in the U.S., move them back to the U.S., move them into the U.S., whatever. And there was understandably some skepticism from taxpayers of like, well, the rate's going to be going up. Could this change? This is now permanent. And so I think this really helps from a U.S. competitiveness perspective, creates that certainty. Yeah, the rate has gone up a little bit, but given kind of where we are from a global perspective with arguably a 15% floor with Pillar 2, and we're going to get to Pillar 2, 14% seems pretty good.
So really, Doug, I would say, a tip of the hat to those taxpayers who were early adopters of FDII shortly after enactment in 2017. They made the decision to bring a lot of IP back to the United States, but then took the time to explain to policymakers why they did it, why FDII was so important, and why it was good for the United States. So I think, again, a real shining star from the original TCJA that now, to your point, we have a lot more certainty about going forward.
Yeah, and again, a pro-growth, sort of U.S. business type policy that as you do contemplate future administrations and parties, it's just like it seems like that could be here to stay. Now,
seems pretty stable.
Seems fairly stable.
Right.
And then the last one, which I think we already covered, was BEAT, which like that's where the rate's going up to 10.5.
Right, the rate's going up to 10.5. I think BEAT remains one of the most challenging provisions from the TCJA in terms of what is it trying to do exactly? It's hard to explain to people, and it always seems to, bite one in the hind parts for some reason, some attribute throws you into the BEAT or causes a problem. I think the Senate tried to go into this and make some changes. In the end, it seems like they were doing more, or potentially doing more harm than good. At least that's how a lot of taxpayers saw it. So they basically just retreated and said, we're going to extend the current system, the current computation methodology, but tweak the rate up to 10.5%.
All right, so now let's move on to what wasn't in the bill, Pat.
Yes, indeed.
Which was Section 899. So I think this was like 3 days, right, before the bill was supposed to go to the Senate floor. And Secretary Bessent, it was June 26, tweeted on X, which is now how we get our policy, right? Even in international tax now. It's one thing the president, now we've got the Treasury Secretary too, as well, blasting big policy announcements on X. And it was quite a long tweet. I'm not going to read all of it, but it did say in part, and this is a quote, that the OECD Pillar 2 taxes will not apply to U.S. companies, and we will work cooperatively to implement this agreement across the OECD G20 inclusive framework in coming weeks and months, close quote, while also instructing Congress to remove 899 from OB3. Now, Pat, I don't think either of us saw this one coming. We recorded the part 2 just a couple of days before. But maybe I would love your thoughts on that. And then really, I think the bigger news is what was in the G7 statement. Although some have said that both the legal authority on X and the legal authority in the G7 statements are the same. To remind,
which is to say, not airtight.
not airtight. But maybe we talk about the G7 statement or any comments you have about this just surprise announcement.
Well, look, it certainly was a bit of a surprise. The first indication, at least I got, was there was a statement made by Kevin Hassett, who is the head of the National Economic Council in the White House, saying essentially something that, and Kevin is a pretty cautious guy, so you wouldn't expect him to kind of just go off the cuff and say things. Well, maybe Section 899 won't need to be in the bill if other countries are able to move quickly enough to, essentially deliver what Treasury is asking for with respect to these taxes. And, our reaction to that, my reaction to that certainly was, on what planet are these other countries going to be able to commit to what the United States Treasury is asking for with a bill that's about to go to the floor, about to go to the Senate floor? Like, okay, yeah, maybe that could happen, but it's not going to happen. Well, sure enough, the next thing we got was the statement from the Secretary. And that's all we got, followed by a statement from the two tax writing committee chairmen, Chairman Smith of Ways and Means and Chairman Crapo of Senate Finance Committee, saying, hey, we've agreed to take it out of the bill, Section 899 out of the bill. We applaud this great development, but we stand ready to take immediate action if countries slow walk this agreement. Well, at this point, we hadn't even seen the text of the G7 statement, right? All we had seen was essentially this declaration of victory on the part of the Secretary, followed up by the statement from the tax writing committee chairman. The statement from the Secretary, to your point, Doug, made reference to Pillar 2 taxes not applying to U.S. companies. So you had a lot of people saying, well, does this mean all Pillar 2 taxes, including QDMTTs? You also had other people saying, well, U.S. companies, what about foreign subs of U.S. companies? How are they going to be treated? So there were many more questions than answers. Fortunately, shortly thereafter, I think it was the next day, we got the G7 statement, oddly enough, or for whatever reason, released through the Government of Canada's website. So that's how it came to all of us. Basically, a single-page statement that essentially provides 4 key elements that we'll get into, but broadly provides principles.
They call them.
Right. Principles that we'll get into, but broadly provides that what the headline of the deal is and what allowed Secretary Bessent to say we're going to pull Section 899 from the bill was really the first of those 4 key principles, which is that neither the Pillar 2 IIR nor the Pillar 2 UTPR will apply to U.S. parented groups. So that seems a pretty clear statement that they're talking about ultimate parent in the U.S. U.S. or foreign subsidiaries don't need to be concerned about IIR or UTPR. Of course, what's not mentioned in that statement is you won't be subject to QDMTTs. Now, in fairness, that was never Treasury's negotiating position. It's still not Treasury's negotiating position. It's not, hey, we insist that countries can't have QDMTTs. Treasury's been very clear. The Trump Treasury Department's been very clear. Hey, QDMTTs, that's entirely consistent with national sovereignty. If a country wants to adopt a 15% minimum tax based on book income, that sounds an awful lot like us. We have a 15% minimum tax on book income. It's not a QDMTT, but if they want to do one, they can do one. So that first statement, that first bullet clearly provides the detail around Secretary Bessent's social media post, the first part of it saying, well, what does he mean by Pillar 2 taxes? Well, we're talking about the IIR and the UTPR. What does he mean by U.S. companies? He means U.S. parented groups. So those are the things that are clearly in scope in this G7 statement. Now, I will say right now, Doug, because we'll get into some of the details, the G7 statement is an agreement to agree. It's a political commitment. It's a big deal. We shouldn't diminish that. It's a big deal when you have essentially at a Secretary of the Treasury or Finance Minister level, these countries, so just to remind everybody, we're talking about, in addition to the United States, we're talking about France, Germany, Italy, the UK, Canada, and Japan. So these are big boys in the economic world. Of course, apart from the United States, these are all countries that either have already adopted the IIR or the UTPR or have committed to do so. So these are countries who are clearly essentially saying, at a finance minister level, we're prepared to change the nature of our commitments with respect to Pillar 2 to create this side-by-side system so that U.S. companies are, U.S. parented groups, there's me saying U.S. companies, U.S. parented groups are not subject to the Pillar 2 IIR UTPR. A big deal, but not legally binding on anyone. Nobody can change their tax provision or their compliance, frankly, based on a G7 statement. You need to see changes in laws, and obviously that's one of the things that lies ahead of us.
Yeah, and we're going to unpack that point, but maybe just to review the other principles, and then we're going to come back to, well, how does this become law, and what are some of the issues with that? The second principle, and I'm going to quote this one because it's a commitment to ensure risk that may be identified with respect to a level playing field, or risks of base erosion and profit shifting are addressed to preserve the common policy objectives.
Yes. It's very clear, isn't it?
Yeah.
So I think
level playing field, we just can't get over this concept of a level playing field.
So it's interesting. The timing of all of this was interesting because just a couple of days before Secretary Bessent's social media post, before the release of the G7 statement, there's a big conference in Washington, D.C., the USCIB OECD conference, which happens every year in June in Washington. So there are a number of senior OECD folks and senior officials, relatively senior officials from other countries here in Washington. Nobody knew that this deal was about to go down, to be sure, but they were basically talking about this is what Treasury is asking for. I think one of the things that's very clear is that what was on the mind of other countries who were concerned about what the U.S. was asking for. One is, are our multinationals going to be disadvantaged relative to U.S. multinationals? And that obviously is a significant concern that countries articulated. A second one was, is this essentially going to lead to just the unraveling, the unwinding of Pillar 2? And so I read in that second statement a couple of things. One is just a commitment that the U.S. is signing up to as well, to saying essentially, we will help shore up the foundations of these anti-base erosion concepts. But we're also, all the countries recognize that this change that was agreed to in the first bullet may create competitive imbalances, and those are going to require some thinking. But beyond that, what does it really mean? Now, one of the things that came out in this OECD conference in Washington was, for a number of other countries, the QDMTT has essentially elevated in importance, or is now much more important than it was prior to this U.S. agreement. Why? Because if you are an official in the UK government and you're hearing from UK multinationals that you've just agreed to a system that's going to make it easier for U.S. companies competing in foreign markets than UK companies, if you can say to the UK company who's complaining to you about that, well, no, the U.S. is going to be subject to the same rules you're subject to, because there are QDMTTs that basically are in place in most countries around the world, and everybody's going to be paying the same QDMTT as you are. So there's not really a competitive imbalance here. That holds true as long as QDMTTs remain in place, right? So that seems to be one element that's really elevated in stature. And I can't resist but mention, Doug, you and I will remember when the model rules were released in December of 2021, QDMTTs were barely mentioned.
Right.
They were not sort of a well spelled out or regarded as
principal element to this
They were not
system.
the linchpin of the entire. Well, arguably they really now are as a result of this G7 agreement. And so shoring up the foundations of QDMTTs and making sure they work, I think, is going to be really important to the other members of the G7. And again, it is something that Treasury, the U.S. Treasury, has essentially acknowledged. We're okay with QDMTTs. So for those of us who play in the Pillar 2 space and are asking the question, do we need to care about Pillar 2 anymore if we're talking to U.S. clients or if we are a U.S. company? Well, for countries that continue to have QDMTTs, and as of right now, there's a lot of countries with QDMTTs, that's a Pillar 2 system. It's based on the Pillar 2 rules, plus the administrative guidance. So don't throw out that Pillar 2 stuff just yet, because all those countries with QDMTTs are going to be applying those rules. So that's a big takeaway from all this.
I agree.
This is great news from the standpoint of what Treasury has been asking for, but for folks who are like, if I just close my eyes, can I just wish this whole Pillar 2 thing away? Pretty clearly not. And again, the other countries have recognized that QDMTT thing, that's really important. We got to make sure that thing sticks around.
Yeah, and I'll note that the QDMTT is not actually required in the EU directive, right, for member states.
That's right.
in theory, it gives those member states some flexibility on
That's right.
how they want to adopt those, insofar
That's
as they
right.
don't actually directly have to follow the directive.
That's right.
Maybe-
Lots to think about there.
Lots to think about there. Maybe two quick pieces just to end on the 4 principles. The third one was material simplifications for administrative and a compliance framework. I view that, Pat, this isn't for US MNCs. I mean, this
Oh,
is
for sure.
around the globe, right?
for sure.
No pun intended.
Right.
Everybody's concerned about the globe information return, the significant complexities. I will tell you,
Right.
those of us as advisors and that are building the technology, this thing is insanely complex.
Yep.
And I think everybody would welcome some simplification.
Right.
I know there's been a number of discussions about permanent safe harbors. I'm not going to waste any time
Right.
on trying to
Yes.
anticipate what those might look like. But I think this was very welcome for taxpayers,
Yeah.
not just US MNCs
Yeah.
particularly, that the
Yeah.
OECD is looking at administrative simplification and trying to reduce the compliance burdens.
Right, right. What I like about that statement is this is coming from, again, essentially the finance minister level. One of the frustrations we have seen as advisors and companies have seen throughout the development of Pillar 2 is it just seems to get more and more complicated. And even attempts to try and make it simpler, like the country by country safe harbor, they take a step forward and they take at least a half step back with the subsequent guidance that says, well, not so fast. We're seeing some things we don't like. So here's a bunch of complex rules you're going to have to apply to do that safe harbor. So I think the simplification aspect of this, it's an easy word to say.
Yeah.
It's been hard to deliver. I think seeing a renewed commitment at a political level is, I think, a good development. I hope a good development, and I agree with you 100%. This is, of course, not based on something the U.S. is pounding the table and demanding on. This is what other countries' MNCs are also demanding, which just got more important to the extent that U.S. companies are now, to a significant extent, not going to be subject to at least the same level of compliance burden associated with things like IIRs. So there's lots to think about.
We're going to come back to the timing on that, because
Yep.
all this has to get enacted before the U.S. multinationals start spiking
Yes,
their
exactly.
footballs on the compliance.
I would never advocate spiking the football on this. to be
Okay.
sure.
And then the last one is substance-based non-refundable tax credits. So
Yeah.
this is now in there. Obviously, the U.S. is focused on the R&D credit.
Yeah.
Their non-refundable R&D credit. It seems like that will be addressed.
Right, right.
But maybe this sort of begs sort of the larger question is, what is the next piece of this process? Like, how is any of this going to get into law? And maybe we'll presumably some form of administrative guidance that we're going to need.
So I think the most likely path forward, and it seems pretty clear, everybody's kind of assuming this will be the same approach. This includes folks within the governments. It's not just me idly speculating. Is okay, there's a political statement from G7 finance ministers who are at that level. This now gets handed essentially over to the inclusive framework at the OECD to say, okay, this now needs to be reflected in administrative guidance. As recently as last week, there was a conference in Europe. Someone from the European Commission was at that conference and said, look, this has to be turned into actionable guidance. We hope that that can happen by November. So there's a process, obviously, between here and there, which is kind of, one, getting the countries that are part of the inclusive framework, but are not part of the G7, and that's a lot of countries.
A lot.
Getting a lot of those folks on board. A lot of those countries, we should be clear, they never loved Pillar 2. This is not a development that they're particularly unhappy about, essentially. But there are going to be certainly some countries who say, hey, wait a minute, nobody talked to me about this, and I have worked very, very hard to produce essentially where we are on Pillar 2 today, and I'm very uncomfortable with the direction of this. So there's going to have to be some convincing along the way to get some of those countries on side with what the G7 has agreed to.
Even just to get administrative guidance.
Even
out,
just
right? Before
exactly.
we start talking about enacted legislation.
Exactly, but exactly to your point, Doug, right now we have a G7 statement. When that G7 statement, let's assume it does, get turned into administrative guidance, well, that's no more binding than a G7 statement, right? So,
or a tweet on X.
Or a tweet on X, right? So the administrative guidance now has to be turned into laws. Now, as we know, some countries have provided in their Pillar 2 enacting or adopting legislation that when administrative guidance is agreed by the inclusive framework, it automatically becomes a part of their laws. Most countries don't do that, don't have that ability, don't have that option, or haven't taken that approach. And so countries are going to have to take these things essentially back to their parliaments, back to their national legislatures and say, please put this into the law. Because until that happens, the provisions that are in their law today remain binding on U.S. companies and and everyone else. So this is going to be a process. It's going to be a staged process. It's going to obviously have to unfold over months. But for companies who, again, this all sounds great, it is great from the standpoint of hopefully leading to a better, more rational system for U.S. companies with respect to Pillar 2. But we are a ways from the finish line here. Things can go sideways along the way, but even if everything goes swimmingly, we're still talking about a period of months, and we're still talking about the real possibility that we slip well into next year, and this is an adopted law in a number of countries. So what does that mean about things like the UTPR?
Yeah.
It still nominally applies, right? It hasn't been turned off.
We're going to come back to this. So
lots to think about.
Lots to think about. One other thing, and this is definitely beyond the scope of this particular podcast, is are these potential changes consistent with the EU directive, for example? And I can't remember if it was there was an EU official that had made some public comment about the G7 agreement that they thought they could do that consistent with the EU directive.
Right.
I think it's Article 52 in the directive that says specifically that a qualifying income inclusion rule has to be by country, cannot be blended. Somebody had their eyes on GILTI several years ago when they made that. So I think there are a whole number of sort of legal and procedural questions, specifically with respect to the EU directive, that remain to be seen. Also with non-refundable credits, is that a substantive change? Because that is very much baked in. So a lot of unanswered questions, and hopefully as we get those, we can continue to talk more about it. But what I did want to spend the last few minutes sort of scenario planning. You were kind of already going there, and I paused you. But maybe the first thing, and we've probably buried the lead here on Pillar 2, but I think the most important thing, particularly for our non-U.S. listeners, is that this generally does not have an impact on compliance responsibilities and potential top-up tax responsibilities for non-U.S. parented groups.
Correct.
Hopefully it means their compliance is easier, but it's very important that just because they've got this side-by-side agreement, that it doesn't mean Pillar 2 is going away. So no impact generally to non-U.S. MNCs, other than hopefully some more favorable compliance perspective. The other point that you had made, which is important for listeners, for everybody, QDMTTs appear here to stay, right? Until countries start withdrawing those. We had 35 countries in 2024, which is a year and a half ago, that have QDMTTs that are enacted. So U.S. MNCs are going to have to comply with the QDMTTs for 2020.
Yeah, no question about that.
And then obviously the rest of the world, whether it's IARs, QDMTTs, and then now with 2025, still having to deal with UTPRs. So now let's focus on U.S. MNCs and what this means as countries start to enact this. Pat, I remember when the EU directive was getting finalized and we had to have, was it 27 member states? The UK leaving really kind of threw me off. It was 26.
I think the number's 27.
I think we're at 27. And that was really challenging to get all 27 member states. The way I kind of am viewing this is that, now we have to have 55 countries, I think we're at 56 now, that have Pillar 2 enacted legislation, other than those that have taken the ambulatory approach that can just treat the administrative guidance as law, which is a small fraction.
A very small fraction, to be sure.
There's going to need to be enactment in each of those countries. And I will remind listeners that were around when the whole Korea issue, when they accidentally implemented the UTPR, a year earlier than we're supposed to. It only takes one country to have a UTPR.
That's right.
For that to effectively collect the top-up tax for the entire world.
Absolutely.
So when we get into 2026, the UTPR safe harbor expires.
And that's on U.S. income. So that's
U.S. income.
Exactly. And Doug, just remember, we just had a bunch of U.S. tax law changes that may potentially create more of a likelihood for U.S. companies to fall below 15% in the United States. So if anything, the recent law changes may even make it more likely that there will be a UTPR exposure on U.S. income of U.S. companies until these other countries change their law.
And in 2025, to the extent that a country has implemented a UTPR, that is currently effective to foreign subsidiaries of U.S. multinationals. So, to get into this scenario, if every country enacts these new changes before 2025, before the end of this year, which feels remote. That might even be generous.
Feels challenging.
Challenging for all of these countries that have implemented these rules in 2025.
Yeah.
The question is, can they go back retroactively?
Right
Back to the beginning of the year. Because again, if there's one country that still has that UTPR, that could still apply to the foreign subsidiaries of U.S. multinationals.
Yeah.
It says nothing about 2024, which, as I mentioned, is a year and a half past.
Yeah.
Presumably, U.S. MNCs are still, to the extent that they have a holding company in a jurisdiction that has an income inclusion rule.
Yes.
Presumably, they still have to do the income inclusion rule, the full globe information return for 2024.
Right.
I think there's going to be a number of challenges for countries constitutionally to try to go back and make that retroactive back to the beginning of 2024. But who knows, right?
Yeah.
Politics can play an interesting role in tax law.
Yes.
That's one important lesson that we've all learned over the
sure.
course of the last 10 years with Pillar 2. So again, the Secretary Bissett talks about these Pillar 2 requirements, but for 2024 feels like those income inclusion rules still likely could apply. In 2025, very possible for US MNCs that the UTPR is still at play for foreign subs. And so that's best case scenario if all of this administrative guidance and every country implements the rules in 2025. Now let's move on to 2026. If these rules do not come out and get enacted until 2026, now we've got U.S. multinational 2 years behind. IRs in 2024, UTPRs for the foreign subs, and then no UTPR because you get the UTPR safe harbor. And then it's the question is, okay, then is it prospective that the IR and the UTPR goes away? The question then is, well, if one country doesn't implement these and then we have the UTPR, then potentially the U.S. parent is subject to the UTPR, the foreign subsidiaries. So does then Congress go and dust off 899? I don't know how much dust it will have collected in these next few short months. In my view, 899 is still a very realistic possibility based on some of the comments that we've heard from Congress. From Jason Smith.
Yeah, I would agree. I think it's way premature to say we've seen the last of Section 899. They made it very clear that the Tax Writing Committee chairman that what they didn't want to see was slow walking or dragging your feet, with respect to getting these things enacted. So I do think that's a real concern. I also think, Doug, even though you didn't sort of mention it explicitly, we get into 2026, let's just focus on calendar year, folks. We get into 2026, you get to the end of the first quarter, right? Well, now you've got potentially a financial statement. You got to do your quarterly provision, right? Does your quarterly provision include the application of the UTPR? It may be that a country has said, we are absolutely going to legislate this year. We'll have it done before the end of June or before the end of July. Well, that doesn't help you when you get to the end of March and you got to do your provision because all you've got, again, is the equivalent of a G7 statement or a post on X or an inclusive framework document. None of these things are legally binding. What you need is a change in law, and if that hasn't happened yet, now you got to close your books. You have to close your books on this basis. So we should expect this to be, none of this is necessarily catastrophic. We should expect it to be choppy for quite a while going forward as this gets sorted out. And again, that's all based on, to your point, Doug, they've landed the plane at the inclusive framework level by, let's say, November. In other words, before the end of 2025. One of the things that G7 statement seems to suggest is that the discussion about incentives, the discussion about simplification, the discussion about protecting against base erosion, and the side-by-side system are all things that they want to get resolved together. Now, it doesn't quite say that exactly explicitly, like, hey, no relief on the side-by-side system until we've resolved the question of incentives, but it sounds like they're talking about doing all this stuff together. That is an enormous lift, and we are here in the middle of July, and they're supposed to wrap all this up by November?
And we know that July and August are generally slow for the OECD.
And exactly. Most of Europe disappears for the last 5 weeks of, essentially from, the end of July through to the start of September. Nothing's going to happen. We should be just realistic about that. And so as a practical matter, given that it's now in the second half of July already, you're talking about the month of September, the month of October, and call it the month of November. So 3 months to wrap up all those sorts of issues. It's going to be choppy. And that's not to rain on anybody's parade with respect to the positive outcomes of the G7 statement. But we've got a long road ahead of us with very challenging timelines. At any point along the way, it can get slowed down. This is, of course, exactly what the Tax Writing Committee chairman were referring to when they're like, hey, just don't forget about us and don't forget about potentially Section 899. So there are things that we'll need to just watch.
And as we watch them, we'll talk about them here on the Cross-Border Tax Talks podcast. Pat, I mean, just the plot thickens.
It does indeed.
And really enjoy having these conversations with you. I really just don't know where this is going, but
Right.
if we leave listeners with one piece is, don't forget about your Pillar 2 compliance obligation for
Could
the
not
foreign
agree
parent,
more.
non-U.S. parented groups, as well as U.S. parented.
For sure.
So thank you very much.
Okay.
Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pat Brown, PwC's National Tax Office co-leader. I'm Doug McHoney, PwC's International Tax Services global leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.